I think that this year we have been making a special effort trying to understand what's coming ahead for us and our clients, multinational clients, both strategic investors, private equity, in this market. I think forecasting China is becoming more and more difficult than ever. We've been doing this now for 18 years. And again, this year has been probably the most challenging year trying to understand what's going on and what might happen. So the title of this year's presentation is Engage and the Risk. Many of you know InterChina already. So we are a boutique investment bank and a strategic consulting company that has been present in the Chinese market for 28 years. We are 50 people, one of the largest and I would say most well-established firms in this specific market. We have two business units, corporate finance and strategy consulting. I think that when people talk about forecasting or even understanding the current state of affairs with China, I think it's very important that we all ask the sources of information. I think that otherwise I would put opinions in quarantine. As I mentioned, this year we made a special effort to get objective data. So for the past 18 years, we've been conducting a survey, usually around September, to build our forecast. So this year we did two surveys, one in June and the other in September. In total, we interviewed and have access to around 500 China Pacific president, Asia Pacific presidents and China CEOs, also some global BU presidents of, I would say, basically traditional industry multinationals in industrial space, consumer healthcare, materials, chemicals, and so on. We also decided to expand the scope from Asia Pacific and China C-suites to European and North American headquarters. So we did a roadshow physically. A few of our partners visited more than 74 executives on more than 10 countries at the headquarter level, including C-suites, CEOs, but also board of directors and a supervisory board of directors of these multinationals. Most of the companies that we've been talking with, I would say they are Fortune 1000 with a high exposure to China, like more than 10% of global profits come from China. They know the market very well. I've been in the market more than 10 years. And the people that we've been interviewing, they are directly involved directly or indirectly on the P&L of China. So this is the main core of the information. So we have a lot of objective data on very complicated topics. The second source of information, I think that is the outcome and the analysis that we've done through our strategy consulting team. This year, we've conducted more than 1,600 field work, directly talking with Chinese privately owned and listed and state-owned enterprise C-suites, asking them questions about market, consumption, competition, cost increase, and all that. So all that wealth of knowledge is reflected on our conclusions. And finally, the third source of information has been all the grassroots learnings from our latest M&A pipeline and track record through our corporate finance team. So this year, we closed six transactions. There were 4 acquisitions and 2 divestments. Behind that, we've been running a pipeline of around 20 projects where we've been looking at a lot of target companies, buying, selling. We did many due diligences, and we got a lot of insights of what's really going on in terms of cost structure and competitive dynamics in China. So we get all this wealth of knowledge, and we reflect it on the report. So these are the sources. So the report today, which we will be sharing with you afterwards, is divided on 3 sections. First one is trying to understand the competitive investment environment for multinationals. The second one will be understanding how multinationals are reacting to this. And finally, we are trying to draw some best practices from all this benchmarking. So let's start with the first one. I think that I will start with a positive note. I think that we all need positive news lately. And I think that one of the things that struck me as more interesting of all the data that we obtained is that 80% of the companies that we were surveying and interviewing, they remain very committed to China. The main reason is hardcore revenue and profit contribution. It's not that only that they have been getting and are getting in 2022 still a very nice chunk of profits sent to headquarters, but all of them, these 80% interviewees, they are telling us that in the next 2 to 3 years, they expect this contribution of revenue and profit to increase up to a point that 40% of them are telling us that they expect to reach on the short to medium term more than 20% of the global sales coming from China. And I could say a broad majority are telling us that China for them will become, if not number one of the top 3 global markets. So the first message is, yeah, we are committed to China. We cannot not be in China. That's what they are telling us. They see 4 Chinas. And I think that it's interesting because in the past, mostly people only saw 2 Chinas. China's a market and China's a global manufacturing base. But now we see 4 Chinas that encourage multinationals to stay connected. The first China, obviously, is China as a market. I think that it's clear consensus that consumption will continue. China is expected to bring an estimated 200 million new middle class into the world in this decade, putting a Chinese middle class up to an estimated of 900 million middle class. I mean, this is more than Europe and the US together. And you can cater in a single country, more than 90 million millionaires, more than 250 million upper middle class, and then lower middle class, and so on. So it's a country that allows you to cater different segments within the same legal and financial environment. So that's the main reason, obviously. Behind that, also, you have a lot of B2B. There are trillions of dollars to be made with decarbonization and new digital technology. So I think China as a market is obviously the main reason. Second, on the ranking of why do you want to stay in China, very interestingly, is China as a source of global innovation. So our clients are telling us that the technologies that are being developed here, not so much at the fundamental innovation, but let's call it at the practical innovation level, will change the market in China. And some of these technologies have the potential to change global markets. So they're saying we need to be part of this technology ecosystem. It's going to be, yes, the US as a global source of innovation and China. So they will create very different standards, and we need to be part of that. The third topic, why do you stay in China? Why do you want to continue being committed to this market? Is China as an industrial base? I think that it's true that I will be talking about that later. Everybody is trying to be less dependent on China, and there will be maybe 10, 15% of what is being done now in China that will go back to Europe, to the US, or to Southeast Asia. But at the same time, everybody's telling us, and we see that from our market study, that void will be very quickly filled by new technologies, where China will become 20, 30, 40, 50% of the global manufacturing base in high, medium, high technology areas that will be growing at 20, 30, 50% in the years to come. So still being here as a global industrial base, it matters for our clients. And then another new China that is emerging is China as a source of global alliances. So if you compare the size of the US economy and their impact globally in terms of global sales and M&A, joint venture, US outbound investment, compared with the China bloc, which is already the second global economy in the world. But its impact globally is very disproportionate. So the estimation is by 2025, China will become an exporter again of capital. And our clients, they want to be part of that globalization by doing joint ventures or just serving Chinese clients from China as a global client. So I think so far, I mean, this is positive, and it states why companies are committed. However, you know, the feeling it's pretty negative about many things. So we were asking people, what do you feel about? How do you feel uncertain about? And we were doing these questions in different moments during the past 2 years. So I think that the conclusion is that so many things that have never changed in this country in the past 15 years are changing in the past 3 years at the same time with an incredible depth and at very fast speed. And these are not the small things. They apply to top-level policies, corporate-level impact issues, and even social fabric items, that affect the society of China. And again, if you look at, this is a complicated slide, but if you look at the highlight orange areas, some of these things are actually very good changes, like a common prosperity, green China, corporate compliance China. They are all good things for China, for multinationals, and for the world. So some other things like international tensions, the relationship with Russia, the elections and the uncertainty, and more importantly, zero COVID policy, they are pretty negative, and they are negative impacting the level of risk. So it doesn't matter whether really are good or bad changes, but what's behind the fear and the uncertainty is that there are so many changes happening at the same time that is creating a lot of confusion. So we've tried through our questionnaires and our model to break this fear and this uncertainty in short to medium term, and also try to have a model to understand the China risk for our clients. So first, if we look at the short-term view, I think that actually 2023 is going to be not a bad year. Generally speaking, our clients are forecasting for their own internal P&L and business plans GDP growth between 2.5 and 3.5. If you read the latest reports of the economists or even some global banks, there is upside that this could go up to 4.5 or even 5. But let's be conservative. Inflation under control, RMB, well, who knows, appreciation, but it could be depreciation. So RMB is a very volatile item now. And then a very controlled labor cost. I think that there are negative and positive factors looking at next year. The first one, negative, is zero COVID policy. I mean, the great news is that this is opening as we talk. There will be a gradual opening through next year. It will not be dramatic. And I think that before it gets better, it will get worse. So I think that's a negative driver for growth. Also, the property market, the great news is that China just announced 11 measures by which it's clear that the property market is not going to go into a crisis, and it will be revamped. But for sure, next year is going to be a drain on economic growth as it restructures. And in connection to that zero COVID policy and property market, then the outcome is that consumer confidence next year will continue to be pretty low. And exports, for the first time in a long time, might be either no export growth or a little bit of export growth. So these are the areas that are behind this 2.5, 3.5 GDP growth. Now, on the positive side, multinationals are pretty happy about the level of stability in China. I think it's one of the few countries in the world that will be very stable. I will be talking about that later. China announced that they will have a limited but very focused stimulus plan. I think this is great news because having a crisis plan like in 2009, that would have been really bad for the economy. So they are being prudent managers by having a limited stimulus plan. There is a steady financial reform that has been announced in critical points of the industry. There will continue to be a consolidation and productivity improvements. And great news is that at least we clear the air on Taiwan. I mean, I think there is common consensus that this will not be a problem in the short to medium term. So I think that this is basically a plus negative analysis for next year. But more importantly, for our clients, I mean, these are companies that are planning to do capital investments, 50, 100, $200 million investments here in China for 2023. You need to look at the medium-term view. So our model basically focuses on 4 drivers to understand the China risk. First is domestic policy, then geopolitics, then all the pressure on single source of supply that multinationals need to address, and finally, the impact of domestic competition. So it's from big things to smaller things at the more practical level. So very quickly, I will go one by one. In terms of domestic policies, after the elections a few weeks ago, I think that we got a very, very clear and firm outcome. You might like it or not, but one thing that there is great consensus about our multinational clients and private equity investors is that with this new Politburo, which is actually filled by a good group of technocrats, but all of them supporting the figure of Xi Jinping, there is going to be a clear internal alignment. Alignment about Xi Jinping's view and policies. So this has been published, announced, and consistently executed for the past 5 years, and they just very clearly announced, black and white, on a 80-page document that you should read if you're interested about China, on what they plan to do for the next 5 years. So as one of my clients mentioned the other day, China is one of the few countries where you can read the last page of the book and be more or less 70% certain that they will do that, what they are saying. So high level of continuity, very predictable political ecosystem. So I think that brings certainty for investors. The second thing, if you look at the latest development and what happened since the Politburo was announced, I think the question of is ideology trumping pragmatism and economic growth is already, you can already see the direction. In our view, yes, ideology is here to stay. So since 2016, you can see a ideological reinforcement that is very new in China. And that indeed increases the risk level of the country, but it will be balanced out with economic growth. It will not be either or, it's going to be both, obviously. So between economy and social stability and ideology, there will be a new great zone that is like everything China has been doing for the past 20 years. They will work around that, and they will have a certain discretionality to adapt to the circumstances. So what are the mitigation factors here? First, pragmatism is here to stay. I mean, that's a very Chinese element, and I don't think that's going to change. Second, the social contract, the 1,000-year social contract in China is not just Communist Party, but this goes back, way back, has not fundamentally changed. And you can see it today, how it's working. I mean, this is basically a very simple contract. The people and the society give power to the party and the government, and the party has to protect and to make sure that their life is better on an ongoing basis. So I don't think that that's going to go back. And also, if you just look at pure ideology, this idea of national rejuvenation that Xi Jinping is talking about, it's directly connected with economy. I mean, otherwise, China will not be able to become bigger than the US, and I think that's part of the big theme. So I spent a bit of time on this slide because I think it's very important to frame the political risk. Now, if among all the topics that they've been talking about on their 5-year plan, we wanted to look at the impact for multinationals. So on top of that, we had interviews with NDRC, with MIT, MOFCOM. We talked with Chinese think tanks and university professors to come to this very simple message here, that multinationals matter and will continue to matter for China. So there is a clear engagement to increase and attract multinational investors in China. I think that there are 4 drivers for that. The first one is that multinationals, from a Chinese government perspective, are critical to continue the export drive and the enabling the globalization of exports from China. More than 35% of current exports are directly driven to multinationals. The second, I think, is more political. China perceives multinationals as potentially their best ambassadors overseas, because if you have a great market exposure, you will try to protect that and reinforce that back home. Another view why government will support this is a very interesting one. They want to make sure that multinationals put pressure on state-owned enterprises to make sure that they remain competitive and they don't get complacent. That was a very interesting angle. And finally, especially if you go to the local level, multinationals, I need to go back to 2005 to see how well multinationals are being treated today. You get a red carpet in many industry parks. You are getting subsidies, free land. Why? Because multinationals are local employers, value drivers, and tax contributors. So I think that there is room in the new China, obviously, for multinationals. But there is another positive angle that our clients are telling us, that one of the big topics behind Xi Jinping thought is moving China from quantity to quality. So you see, they are creating a quality country based on governance and compliance. So a lot of the revolutions that have been implemented in the past 5 years and that have been announced to continue are about taxes, compliance, green cost, labor security, and all that. So many of our clients on the survey, they were telling us that they believe that in the next 3 to 5 year cycle, there will be finally a more level playing field between multinationals and Chinese domestic competitors. And it's just an input that their cost level will increase and they will need to increase prices or reduce cost. And I just asked my team to prepare this slide. This reflects a due diligence that we did on a company 2 years ago that we couldn't buy. And then today we bought it. And this company was on a roadmap to be listed. So they have to apply compliance in China. So 2 years later, you could see a dramatic change on the P&L. They couldn't issue sales without VAT like they did in the past. They need to increase and pay Social Security like anybody else. They had to do, they lost subsidies that they couldn't sustain. They had to increase, sales in terms of security and compliance and green cost. So at the end, this company had to increase prices to sustain profit levels. So I think this is a very interesting positive outcome. I mean, in a more quality-driven China, multinationals that have been following quality standards for many, many years are in an advantage to local companies that are learning how to do that today. Okay, so that's the first one, domestic issues. So more or less, black and white issues there, but generally speaking, I would say is in favor of multinationals. Now, if we look at geopolitics, I think this is much more difficult, and this is I really don't see positive news on this. Our clients are betting very clearly that the relationship between the US and China will not get better. In fact, it has more downside than upside potential. So there will be negative drivers in terms of restrictions to technology, goods, trade, technology. There will be more reshoring back to the US, and there will be topics around Taiwan or Hong Kong or whatever is necessary to create troubles. It will be done. So that's a negative part. The good thing is that Europe, I think that not only our clients, but also we get a lot of feedback from government officials and a European Union think tanks that clearly Europe is not going to blindly follow the US. They will try to create their own balance. There will be more firm issues around values and to reduce the European Union dependency on China and all that, but they will try to engage in a positive cycle with China in economy and other elements. So anyway, geopolitics is going to get crazy. The world is breaking into blocks. I mean, that's clear for most of our clients. However, we were asking a lot, are we going into a scenario where there could be a Cold War, or are we this disruption of the globalization into regional blocks is going to be completely firm or not? And the conclusion, and I just got two data on this slide. One is this map of the world in 2000 and 2020. In 2000, before China joined the WTO, most of the global trade was driven by the US. Today, after 20 years, 90% of the global trade, China is number one or number two global trade partner. So China, in comparison with Russia, that was born into let's call it a closed loop, and they are more disconnected than connected. China has been born into maturity as a global partner. Is a son or daughter of globalization. The structuring this, in my view, is going to be impossible. And the second issue that a zero-sum disconnection is not possible. It's just the cost, not only to China, but Germany and the US and other key countries. This data is provided by a German think tank that say that if there is a complete bilateral decoupling, Germany could lose on a long-term basis, on yearly basis, long-term basis, 0.8 points of German GDP growth. The US would lose 0.5, and China could lose 2.3 points of growth. I mean, I don't think this is going to happen. Now, if we go to scenario analysis, our clients, they are broadly betting for what we call constructive decoupling. We did two surveys, June and September. In June, there was a lot of confusion. There were many people saying, well, it's difficult to judge. But in September, 78% of people say, you know what, our board, our CEO, our company, EXCO, we are betting on constructive decoupling. Constructive decoupling, to make it simple, it's a sort of a bipolar disorder where countries or blocs will push with one hand for creating political conflict, tensions, and identity separation, while with the other hand, an equal energy, they will push for trade, investment, cooperation, and cooperation at all levels, environment or whatever. So it's one body, two completely different behaviors. So this is going to again increase the level of risk, but at least there will be certain predictability on what will be, the positive and the negative areas there. So if I go to the third area of risk, so I could say the pressure on single source of supply, restructuring to multinationals. So I think it is clear that there is going to be a trend towards reshoring. I mean, it has to happen. And but how it will happen, it's also clear that it will not be a complete cut. The China plus one option, so China and other solutions, it seems to be, by our replies from our clients, the way to go. And I think I just chose two reasons why I don't think a complete disruption of supply chains will happen. China is already, number one supplier in the world, not only on raw materials, but many components, industrial players. I don't think that there is any capability in the world in the next 10 years to absorb more than 20% of what China is doing now at cost, remaining competitive. And especially if you go to critical supply chains like the decarbonization supply chain, 80% of solar is in China, and it will not be, as our clients are telling us, it would not be industrially feasible or economically feasible to have this capacity restructured to other countries in the next 10 years. So again, I think China plus one is the way to go. And finally, the last risk driver, and I think this is the most meaningful for multinationals. Oh yeah, of course, we need to know what's going on with the government at the domestic level. Of course, we need to be very worried about what's going on geopolitically. Yeah, I mean, we cannot depend so much on China, but actually what is damaging multinationals at the P&L level is the emergence of Chinese competitors. And I'm not talking now about state-owned enterprises or the traditional China champions listed, but the one that is emerging for the past 3 years, we've been monitoring this trend, is these new local premium players. These are companies You can find them everywhere. In any industrial category, there are 3, 4, 5 of those. They emerge from the low cost of, let's call it, mud, and they reinvented themselves in technology drivers. They were, raising capital at a tremendous pace. They're very good companies. They created a new segment, which is not medium or high. We call it the good enough market, where speed and, good enough technologies that are still a little bit cheaper than multinationals are flying, and that's the new battleground. The good news about these companies is that you can acquire them. You couldn't acquire listed companies, you couldn't acquire state-owned companies, but these players, 500 million RMB, 1 billion, 2 million, like $200 or $300 million, you can buy them. So it's both a risk, but also maybe a joint venture or inorganic growth potential. Okay, so this is basically to look at the investment environment. My conclusion is that the China risk level is going up for many reasons. There is still a great commitment to the country, but companies need to be more worried than in the past. So how companies are reacting to that? I think that here the key message of this section is we see the advent of a new China formula. What we learned in the past 10, 15 years to make money in this country, and again, many people made a lot of money, I think that not necessarily is going to be applicable in the next 5 years to come. So the first message, and we've been getting continuously this statistic, whether it's 71, 75, 78, this year 71% of our clients are telling us that in the next 3 to 5 years, they expect that they will lose all the competitive advantage they traditionally had by being a multinational in China. The plug and play model, where they have a global technology platform and they kind of localize it and sell it in China, that's not working anymore. They're losing competitive advantage very, very fast. And they are losing it to local competitors, but also they are losing because there are lots of disruptive technologies and new demand patterns, and also because in some industries, there is a lack of market access. So the result of this is that we already see how companies are trying to revamp a new China playbook. How should we engage with China? Our strategy team has been doing more than 15 projects last year only on this topic. So I'm gonna show you some of the tools that they use. First one, the 70-30 China. I mean, this is the way we look at the market in an effort to help to reply the question of in which China am I playing? Where is my playing field? What are the rules of this playing field? And here, basically, we see that there is a 30% China that is becoming more restricted than ever, really intense. And then the other 70% China is actually pretty open. And the rules of the game are, I would say, pretty much market-driven. And then you see the emerging 20%, what we call in gray, shifting China, that it could be shifting because there are open China segments with restricted China elements like data, healthcare, e-commerce, smart mobility, or because you are on open China, but because of the competitive or demand dynamics, a great majority of your competitors or clients, like 70%, are state-owned enterprises. So where are you? Are you in open China, in restricted China, in shifting China? It's critical to reply this question and understand the rules of the game of that China, because it's not the same. Second, a different angle to reply the question of where am I, is the traditional China, the 80-20, the traditional China versus new China. Traditional China is where most companies are, mature markets bound to consolidate, where price margin erosion is taking place. In these areas, pharma, construction, chemical, engines, auto, the rules of the game will be reaching a scale and competing by efficiency and research and development. And this is a market where for the first time in the history of modern China, multinationals will be able to use M&A to reach market quota at a significant level. This is very, very new. This is the emergence of what we call transformational M&A deals for multinationals. And then we have the new China. The new China, they call it here bottleneck China. This is the area that China needs to develop by itself. It's usually very much connected to restricted China. It's an area that's going to grow super fast and a lot of organic growth. But multinationals will most likely need to be forced to grow through partnership, alliances, joint venture, or minority joint ventures, and that kind of stuff. So again, where are you in the 80-20% China? Pretty important. The outcome of all this China playbook revamp is a new formula, and this is the core of the presentation today. So we see a formula where companies will need to find the right balance between engaging and de-risking at the same time. So how to engage and the risk. Engaging, I will be explaining that, and now it's going to be more about scale, localization, playing local ecosystem. De-risking is how to de-risk China of the world, but also the world of China. And I think that in this formula, there are two enablers that if you don't have them shape up, the formula will fail. The first enabler is achieving a real HQ, headquarter to China alignment, and using inorganic growth to speed up this change and this transformation. So this is the new formula. We'll go quickly through that. Engage. The first thing, scale or relevance. I think that the period of corporate development in China where you could just have many small business units growing fast and making profits, but still, they were number 20, number 18 in terms of market quota in China. That model is not useful anymore. The main driver of this search of scale is consolidation. We were asking this year, more than 60% of our clients are telling us that the underlying industries are deeply consolidating. So their concern is that even one client was telling me he's growing at 20% every year, even in the past years of COVID, making nice profit. But he says, if I continue growing like that, in 5 years' time, my market quota, I estimate, will be smaller than today because I am not part of the consolidation drive. This is an industry where there are 150 players, and my client is estimating that there will be 20 players in no more than 3 to 5 years. So we were asking again this year on what does it mean to grow fast for you? What do you need to achieve in terms of growth to become scalable? And more than 50% are telling us that they need to increase X2 in the next 5 years, 8% X3, 3% X5, outpacing the underlying market growth. So we're talking about growths of 20, 40, 60% per year. So I think it's very, very relevant to put this in context, And if you cannot grow like that, if you have a bottleneck that doesn't allow you to grow like that, either internal or external, then maybe this is one of the business units where you should rethink so you can put your efforts in another type of portfolio restructuring exercise. The second area of engage is deep localization. So I know that most of you you feel local because you have a factory and all that. But we're talking about the next wave of localization. I think that a great part of our respondents to the survey are telling us that they need to be deeply localized. 82% of the motivation is we need to do that in order to be more competitive. So we're talking about China for China or even decoupling in some critical areas. So this is our inter-China's model. It's just a summary. Of course, the model can become more complex, but we apply the 70-30 China. If you are in the 70% open China, you basically need to make sure that you become commercially and operationally Chinese. And that's an outcome of factories, but also research and development, deep innovation, people, governance, finance, and technology ecosystems. If you are on the 30% restricted China, then you need to become politically Chinese. And that means using equity, like joint ventures, selling majority, being part of the stock market, doing corporate venture capital, whatever it is, So I think that where are you in this map? What is your plan for the next 3 to 5 years where your clients are asking you to be in this map and what you do about it, to me, is probably one of the most fundamental questions to ask. And finally, the last element of engaging is playing local innovation systems. This is basically, how can I grow into the new pockets of growth so I can revamp my 3, 5, 6, 8% growth model on these traditional industries and jump into the new ecosystems. And I think that China is already doing that. Chinese companies are doing that by doing corporate venture capital, minority joint ventures, commercial alliances with a complete new set of players. Like you sell a piece of equipment, and then suddenly you create an ecosystem with financing, banks, insurance companies, product, big data, and you create a new solution that is super competitive. So I think that that's really very much needed in this market. Okay, this is for engaging. Now, de-risking, everybody's talking about that now. We've been doing already 7 projects about de-risking China with our clients at Global, ExCo, and China CEO level. And I think that it's very interesting to see how de-risking start to emerge into something meaningful. And I think that there are 2 de-risking. The first one that HQ is asking for, I want to de-risk my global balance sheet of China. Okay, that's one topic. But the other one, which is most of your clients are asking in China, is I want to de-risk China from global risk. So at the end, de-risking, you will need to look at the supply chain. You will need to look at China for China. You will need to look at a lot of corporate restructuring mechanisms and financing. So I'm not going to go through all this in detail. If somebody has questions, you can approach me later. But I just selected some interesting or provocative ideas that might give you food for thought. The first one, obviously, is this China +1. You need to diversify the production footprint. I mean, that's de-risking global of China, one of the elements. And again, here, we were doing a very detailed survey about what you want to do. Is it India, US, Vietnam, others? And at the end, a great majority, I think more than 90% of the people we interviewed, they told us that China +1, they don't want to leave the China supply chain. They just want to have options to prevail in case of disruption, So I think that that's one message. And the other very interesting message is that China is a continent, it's huge. So there's a lot of people that after COVID-19, they are trying to diversify their provincial production footprint within China. So they have different factories to leverage, local production sockets. So I think that's the first one. The second one is the idea that if you want to prove your commitment to Chinese clients and also to de-risk global from China, you need to become completely integrated. It's like a sourcing integration. The whole supply chain has to be in China for China. I think that that's already an agreement in many boards. A very interesting one to protect China from global is how companies are very fast trying to find solutions to reduce the US content on their product sold to Chinese companies. I mean, that's a hard requirement, especially after what every Chinese saw happen with Huawei, that because of a US extraterritorial Congress ruling, Huawei lost its whole mobile division. So nobody wants to be on that. So I think many companies are trying to remove US content from products sold and made in China. Here, the key issue will be patent registration in China for China. And then we even see some, in dramatic cases, some companies that are thinking to move their products, their IP, their production, or even their headquarters out of the US jurisdiction to Asia or even China. Again, this is not for everybody, but I think it's just an interesting trend, And then finally, another obvious way to de-risk is more joint ventures. We see how a great amount of our clients that they were not interested to do joint ventures 5 years ago, they are proactively engaging us now to do joint ventures or restructure their old joint ventures. And there are 2 motivations. One is basically to split risk, economic risk. We have a client now that is going to invest $150 million on a highly capex intensive factory. The board doesn't want to have all that exposure to China. So we have a 50-50, well, actually we control but still 49% Chinese contribution on that cash. So you reduce your exposure financially at the balance sheet level, but also many companies are doing what I call big brother type of joint ventures, where they are partnering with state-owned companies or very, China champions, to be protected in restricted industries. So they protect the market quota. Many companies are restructuring their risk by doing portfolio restructuring. I mean, we had 1 or 2 cases this year where we sold business units of clients that believe they couldn't reach scale or become local and competitive in China, and they wanted to get that money to be reinvested in RMB to RMB in high growth business units. So I think that divestments, for multinationals is becoming something very serious. We've done more than 12 of those in the past 3 years. So I think that that's, this is another way that will continue happening. And then final, again, food for thought, how to use the stock market to the risk. And we are already listing one business unit of a global multinational in the Shanghai Stock Exchange. And we think that this is, we are in 2 other projects where we are buying into controlling positions of Chinese listed companies. So to me, playing the stock market is, let's call it an all-in-one. So you get at the same time local phase, you get scale, and you localize, because these companies usually are pretty good. And now the prices are going down. So it's something that you could afford. So again, another trend for de-risking. Okay, in terms of 2 enablers, very quickly, in organic growth, I think is 75% of the people that we interviewed, they are telling us that this is a key strategic model for them to achieve their future goals in China. There are 3 M&A drivers: scale, localization, and ecosystems. It's the same that I mentioned, so it's super aligned. And many companies are doing not only one, but they are doing multiple M&A. So I think M&A is going to become critical to do this at speed. And then HQ China alignment. I think that 80% of the companies that we are interviewing, they are telling us that relationship with their headquarters is one of the top 3 challenges in China. Because of a lack of understanding, there are either no decisions or slow decisions or incorrect decisions that are having a huge impact. So the fact that people cannot travel to China for 3 years, the fact that the ecosystems of HQ is changing, and there is a lot of political, media, and social pressure on anything against China, and the fact that things are changing in China so fast, these 3 things together are creating an impossible ecosystem. I just came from 2 months visiting 8 countries in Europe, and I've never seen such a huge divide between HQ and China in my life, 22 years in China. So I think that, in my view, this is the #1 competitive disadvantage of multinationals now compared with local. So this has to be addressed. Now, very quickly, multinational benchmarks. We do this every year, trying to look for the best practices that people is betting off. So I think that this benchmarking goes around governance, IP, and investments. Again, you can take a look at this presentation later. I will not go in detail. I just selected some of them that I think are innovative and interesting. The first one is the emergence of new governance tool to bridge this gap between HQ and China. So it's this idea of the China advisory boards. We started to see that last year. This year, I already know more than 15 companies that have created a China advisory role, which is like a shadow board between the global board and China. It meets on regular basis with a very clear mandate to bridge and meet, bring people and sharp strategy. So we created a few of those, and I think that this is going to become a great enabler. Second, local innovation, not just opening research and development centers, which I think is a 5-year trend. It's been already been here for a long time, but it's the idea that you need to develop patents to be registered in China. And these patents is what gives comfort to local clients. So it's not just bringing your best technology, that's not good enough. You need to develop innovative solutions in China for China and in China for global. This whole idea of a more flexible identity, companies, we see how double branding, innovative branding, joint ventures, either to access sensitive markets or to partner up with low-cost partners that give you access to this good enough market that I mentioned, which is between medium and high end. It's a clear trend, and companies are happy to have a more flexible Chinese identity. Many companies are updating the China M&A playbook, especially if you want to grow inorganically. Everybody's thinking, okay, maybe I should localize the way I do M&A. I cannot run this from Detroit or Brussels. And then we've done a lot of this work, and then you discover that there is not a China M&A playbook. There are 3 M&A playbooks that are completely different in terms of synergies, target profiling, deal structure, governance, deal sourcing, whatever. You have the scale playbook, the localization, and the ecosystem playbook. So as a conclusion, and I will stop now, like every year, we try to bring 5 points that we think could be CEO, either global or China, agenda items for next year. The first one, you need to have, in my view, a reply on in which China am I? How do I engage? How do I de-risk? What is the role of inorganic growth for me? And how can I achieve or maintain alignment between HQ and China? These are the key questions that if you don't have an answer, I think that you should look for one. Usually I would finish with this, but I just want very quickly to share, let's call it a more philosophical idea. As the world breaks in blocks, each block, and I've seen this emerging since 2018, each block starts to create its own story, and they sell that story through media, government, NGOs, civil society, whatever it is. The story is sold to its people. So I've seen that in China. There is a clear story being sold in China. I see it in the US. I see it in Europe. Every country is doing that. So I think that one of my friends, is a Harvard professor, was telling me the other day that we are entering an era of the fragmentation of truth by media. And in order to find the truth, you will need to read the streams to find the middle. This is an exercise I do every year in my company. I look at the hot topics about China, and then I look at the Western narrative and the Chinese narrative, and there is really, it's like, complete opposite views. And then our boards, our board of directors, our CEOs, our China employees, our clients, they all get their own narrative. And I think that that's a very important risk level. So here my contribution to you, and that's what I'm trying to do to myself. I'm trying to have a change of attitude, more empathy, more curiosity, and more creativity on everything related to China and cross-border with China. So these are 3 soft items that I think are going to become critical to continue being successful in this market.